Fantastic. Let's start now. Today's agenda, we would be doing employee comp. For most, most would say that these are the most challenging topic for most of you. Okay, Arpit will solve that. For most of you, it's the most challenging topic in the level 2 FRA. For both the topics, for some reason, I feel CFA curriculum has not done a great job, especially with multinational operations. I think the presentation is very confusing. They use monetary assets before they actually explain monetary assets. So they use reference to monetary assets, and then 3-4 pages after that, they explain what monetary assets are. So these chapters, if you're doing this crash course, my hope is that everything gets covered for you, so you don't have to worry about it separately. All right, so let's start with the topic right away. I'll start with employee comp. What I've done is I've broken down this topic in roughly 8 sections. We have to do those 8 sections and then employee comp is done. So I'm going to make a list of those 8 sections for us so that we have some sort of a reference to where we're going today, and then we'll start with the topics right away. In the first section, we have to do something fairly straightforward, which is your normal salary accounting. There is one small nuance that I want to discuss with you. I don't think this will be tested, but in case if it does, then we should not be losing out on the brownie points. Then on the second section, we're going to have discussion on share-based comps, right? Simple RSU type of stuff. For each of these sections, I'll be creating one practice example for you. In the third section, we would be doing how to do accounting for ESOPs. This is accounting for shares, accounting for share-based comp, accounting for ESOPs. Then the fourth section, which is very interesting, is where we will have some discussion on tax treatment. My guess is if I were writing the level 2 question sets for the exam, this is something that I would have liked to test on, because this section has very analytical implications and is also very important from a practice perspective. So I'll do one example with you so understand what exactly is happening here. Then section 5 again gets a little technical. We have to do this thing called the treasury stock method. We'll have to do one calculation on this. It's going to be a big calculation. Will take us some time to get through it. Then section 6 is going to be theoretical, where we have valuation implications for these. Now at curriculum, this is spread in 3-4 different sections. What I've done is I've summarized all the valuation implications for you at one place. So we'll discuss all of them together. And then finally, we will do one section on financial modeling for the number of shares. Okay. If a question shows up from this, it's going to be super technical. And I think this could be your competitive advantage if you understand this part well. And then finally, we'll have a little bit on accounting and disclosures. This is a fairly nuanced section, so we'll take us some time there as well, especially with memorization of what goes into P&L, what goes onto balance sheet, what goes into operating section, what goes into non-operating section, what goes to CFO, what goes to other items. It's all those nuances we need to know, US GAAP, IFRS, and all that stuff. That will come in section number 8. This is roughly the plan for employee comp. My target is to do it in about 2.5 hours because the next reading is relatively smaller, so we should be able to wrap up faster. All right, so let's start with section number 1, which is normal salary accounting. This is straightforward. So section 1, which is your salary accounting. Let us say that you've hired an employee, and the monthly salary is monthly salary. Just for simplicity, I'm going to make it as $30,000. That's really high, even for a CFA charter holder, but let's assume it's $30,000. And you want to do accounting for day 1, day 2, day 30. Okay, how the accounting will work. So you tell me on day 1, if I'm preparing an income statement, will there be an entry for this salary expense on day 1? Yes. How much will that be? I will create a compensation expense of, let's do a linear, let's forget about Saturday, Sunday and all that stuff. It will be an expense of 1,000. Second effect, cash will go out. No. Why is that? Correct, because cash, so your expense is accruing, but your cash is not going out, right? So on balance sheet, what we do is we create a current liability, which is compensation expense payable, current liability. First day we'll create, or salary payable, we'll create a liability of 1000. Then on day 2, we will recognize one more expense in my salary account, that will be 1000. Now day 2, my current liability will go to how much? It will go to 2000. So it's called accrue. Your liabilities or your expenses are being accrued, so liability is increasing. On day 30, expense of 1000, current liability of 30,000. However, this is where you will say less cash paid, 30,000. So now closing current liability becomes 0. That's it. And then second effect of reduction in current liability is reduction of cash. That's it. This is your simple, straightforward salary accounting. Is this okay? Any questions here? No. All right. By the way, in case if you're interested, this is IAS 19. This is the IFRS accounting standard. Now, some terms that I want to cover here and some concepts. Number one, in some cases, the salary comp can be capitalized. Do you think that's possible? In some cases, instead of showing this as an expense, you show an asset. In what situations? Research and development takes us to US GAAP and IFRS, whether R is expense or D is expense, right? So it depends. But where else do you think this will be capitalized? So think of a simple situation where your employee is working towards installation of PPE. Is installation cost capitalized? Yes, under both US GAAP and IFRS. So imagine my employee is working towards installation of certain machinery, it gets capitalized. In some cases, your salary comp will be added to inventory. When? If you have a manufacturing entity and let's say your salary cost happens to be labor cost, which is directly involved in manufacturing, processing, packaging, all of those stuff, then it gets loaded to the cost of inventory. So it is not an expense, it gets capitalized, you create an inventory out of it. All right, so that's fairly straightforward. Nothing fancy here. Then 3 terms we need to discuss in this section, and these will be repeated multiple times. There is something called as a grant date. Then there is something called as the vesting date. And then there is something called as the settlement date. Can anyone tell me what grant date means? Correct. The date on which, let's say, ESOPs are issued, employee stock option plans are issued. That date will be called as a grant date. Right? Date of which I tell my employee that, hey, you're eligible for ESOPs and these are the conditions. If you meet the conditions, you will get the ESOPs. So day on which I make the commitment in writing, that becomes my grant date. How about vesting date? Date on which the ESOPs are, now I'm using my own language. The correct language here is the date on which ESOPs are vested. But I think the date of which ESOPs are exercised, no. The date of which ESOPs are earned. Okay. For example, at the time of issuance, I say that, okay, you're eligible for ESOP plan, but my vesting condition is, okay, let's say vesting condition is that you work for 3 years. This is called a service based vesting period. So if you work for 3 years, let's assume that this is time 0. This is where I issue ESOPs. So this becomes my grant date. Okay. If employee works for 3 years, so this is time 3, this becomes vesting date. It is not necessary that all the options are exercised on vesting date. It is quite possible that they vest you in the 3 years, but the settlement happens on the 5th year, right? So then let's say that on year 5, employee exercised ESOPs. Okay. So if year 5 employee exercise ESOPs, that means they gave you the strike price, they took the shares from you at a cheaper price, then this will be referred to as the settlement date. Is it okay? The general principle is that if you are doing accounting, then the value that matters to you is this value. Okay, so the value that you care about is this. So for accounting purposes, we will take fair value on grant date. We will not be worried about how the value changes after the grant date. For example, like let's say today I decided that we will issue ESOPs for a particular company, then whatever is the fair value of those options today, that value gets locked in. That's the value I will use for accounting for the entire tenor. Is that okay? So for as far as the accounting is concerned, whether these are issuance of shares, issuance of restricted stock, issuance of ESOPs, the date, the value that matters is the fair value on the grant date. However, for tax purposes, because remember an organization prepares two income statement, correct? One for accounting purposes, one for tax purposes. Tax purposes obviously as per tax laws. So for tax purposes, the value that's going to matter is this value. So for tax purposes, when I need to show expenses, I'm going to show expenses based on the value at settlement. I'll show you. We'll be doing a specific example on this, but this is just a general guideline for you. So for accounting, we do grant date accounting. And for tax purposes, we look at actual benefit that the employee has received by those shares or ESOPs. Are we okay here? All right. So I think that concludes section number 1. Let us create section number 2 now. This is accounting for issuance of shares. Okay. Let's say this is 1st January, year 2000. Let's assume you issued stock to employee, 10,000 quantity. Let's reduce the quantity. Let's keep it 100 quantity. Fair value on the grant date is 40 rupees per share. Vesting period is 3 years. Now, an accounting estimate of how many shares will vest. Let's assume that's 80%. Now, this is an accounting assumption. That means, even though I've issued 100 shares, as an employer, I know that not all employees will work for 3 years. There will be some who will leave job in the middle of the 3 years, right? So not everyone will become eligible. So I'm making an accounting estimate, like how we make accounting estimate for depreciation, the useful life, similar. So my assumption here is that only 80% will vest. That means 20% will not vest. Now this assumption is critical. Let's say now you go to 1st January 2001. Now you do a new stock issue for employee, stock-based compensation. Now the quantity is 100 again, but now the fair value happens to be 70. All right, the share prices have gone up. Here also you have a vesting period of 3 years, and here also your assumption is 80%. All right. Now based on this information, what I want you to do is, I want you to figure out what will be the income statement and balance sheet treatment for year ending 2001, year ending 2000, year ending 2001, and year ending 2002 for each of the 3 situations. In fact, let's go a little longer. Year ending 2003. So 1, 2, 3, 3. I think 1, 2, 3. Fair enough. This is good enough. I want you to do accounting on income statement, on balance sheet for this stock grant. Let me give you some more pieces of information you might need. 2002 stock price ending is 90, and end of 2003 stock price is 110. Okay, start. Are we done? Come on, I'm expecting each one of you to participate. Please be active on the chat box. Give me answers. Like, we have 4 hours to learn. Let's make the most of the time that we have. Let's do it together. Observe, it's simple. If you think about it carefully, you realize it's really, really easy. First thing, any stock price after the grant date, I don't care, right? So we don't care about 90, 110. The only stock prices that matter to us is this 40 and this 70. Now, what is the total value of these shares? 100 shares into 40, how much is that? 4,000. 100 into 40. However, are we expecting all of them to vest? No, my vesting assumption is 80%. So I'm going to recognize expense only at 80%. Right? So typically management will give, and on the exam, they will give you something like the number of shares management estimates to vest. Right? So you have an idea of how to do accounting. So this is 4,000, this is 3,200. This 3,200, I'm going to divide linearly over the vesting period of 3 years, which means each year I will get how much? So first year 1067, second year 1067, third year 1067. Okay. On balance sheet, what is the second effect? Second effect, cash goes out. You create a liability? No, sir, you do not. You're giving shares to your employees. Is there a current liability that you need to pay in cash? No. So what should be the second effect? Second effect, on balance sheet, under balance sheet, you create a reserve. Okay. So the moment I say reserve, that means it is going to be a part of equity. What is this reserve called? This is called employee comp reserve. Employee compensation reserve. First year, I will have 1067. Let's call it ECR, employee comp reserve. Next year, that 1067 will get accumulated. Correct? So 1067 plus 1067, kitna aata hai? 2133. And then third year, that 2133 will further accumulate 1067. So third year, that number will become, help me out, 3,200. Okay. Now, let's assume that at the end of third year, the management assumption was correct and there was actually a 80% vesting. So these shares are now subscribed. These shares are given to the employee. What would be the effect of that? Will we again pass a P&L entry? No. Then we will say less shares issued, 3,200. So this employee comp reserve will become 0. What will be the second effect? It will go into paid in capital. No, we are not receiving cash. Sarvesh, mere bhai, hum log, we are giving shares to the employees. There is no cash received. Cash received comes when? In case of ESOPs. If I'm simply giving shares to the employees, I'm just telling them, hey, you work for me for 3 years, you get the shares. So every year I recognize the expense, I create a reserve. Third year, I just transfer that reserve to paid in capital, which is nothing but part of my share capital. So it's basically a transfer entry from one head to another. Both of them are equities, right? So my total equity remains same, but now this moves to paid in capital. I have a paid in capital of 3,200. That's the increase in my capital. This is the treatment for the first item. That means the first shares that were issued. How about the second one? Let's do the math. 1,000 into 70 into 80%, 5,600. 5,600 divided linearly for 3 years. How much is that? 1867. So 1867 plus 1867 and 1867. What will happen to my reserves? Goes up by 1867. Then this goes up by 1867 plus 1867. How much is that? 3733. Reserves are accumulating on my balance sheet equity. And finally, this becomes 5,600. Then we will say less shares issued, 5,600. This becomes 0. And then we will have a paid in capital. Paid in capital, and paid in capital will become increased by 5,600. This is the accounting treatment for issuance of shares. Take the vesting price, multiply with number of shares, multiplied with if there is a vesting assumption. If it's not there, assume the whole thing gets vested, which is a fact, by the way. Most of the companies, they account for vesting based on, they account for forfeiture as they occur. Forfeiture means Okay, I give you the shares, but you didn't work for 3 years. Give me the shares back. Those are not my expense anymore. So companies account for forfeiture on actuals. Okay, and if there are no forfeitures, you just do the accounting this way. That's it. I didn't understand 1867 part and 2133 part of ECR. Where is 2133 here? Can you please explain the balance sheet again? See, I'm accounting for both of these separately so that, and I'm color coding them so you understand what's happening. What is really happening here? You're going to your employee, you're saying, okay, I'm giving you 100 shares. Today the shares are worth 70, but you know that only 80% of them will be vested. So my total expense is 5600. All that I have to do is divide this expense over 3 years. So year 1 expense is 1867. This is calculated as 5600 by 3. 1867, 1867. What is the second effect of this? This is a P&L debit. Correct? What is the second effect? In equity, you create a reserve called employee comp reserve. Okay? And second effect of this, you add there 1867. Now next year, your opening reserve will be 1867 from last year. Now you say plus this year's 1867. So now your total reserve will become 3733. Next year, your opening reserve is 3733. Then you add 1867 again. So now your total reserve is 5600. Now what you do is, if the shares are issued to them in the third year, then you say less 5600. I don't need that reserve anymore. This is 0. And then your number of shares have gone up. So you need to increase paid in capital, equity share capital. And that amount gets increased by the transfer of this amount of 5600. That's what happens. Are these non-cash expenses? Yes, they're non-cash expenses. What will happen if they're 100% vested? Then it's change in accounting assumption. You adjust your number of reserve that year. For example, second year you feel, okay, I made a wrong assumption of last year at 80%. It should have been 100%. So then you revise what is the total reserve. How much should have been debited by now? How much should have been shown as an expense? How much is the deficit? Show that as an expense. It's a change in accounting assumption. That's it. Is the paid in capital last year total to 8800? I mean, of course, there will be other paid in capital, right? I mean, you have issued shares, you're doing a business. There's an increase to that paid in capital by this amount, 5600 plus 3200. What is the difference between ECR and restricted stock unit? No. See, they are not comparable. ECR is a different thing. Restricted stock unit is a different thing. What are we learning here is we are learning how to do accounting for issuance of shares to the employee, not options. I'm giving shares to the employees. Now, what kind of shares can I give? I can just give plain vanilla shares. Or I can give RSUs. RSU stands for restricted stock units. They're nothing but shares, but you don't have voting rights. Or I can give them phantom stocks. Or I can give them stock appreciation right. Whatever it is, it doesn't matter. My accounting is same. On the date of granting those, what is the fair value? That fair value, I'm going to do a straight line amortization over the vesting period. That's it. And the second effect of these expenses, I have to increase in equity. That is called the employee compensation reserve. So the entry will look like this for those of you who are confused. This is year 1. This is my balance sheet. This is my income statement. Okay. Now I already have some paid in capital because obviously I'm a running entity. I have my own paid in capital. I have other reserves, like I might have retained earnings and all of that stuff. Now in year 1, what we show is we show employee comp expense of 1067. But towards this expense, I'm not paying any cash, right? So the second effect of this 1067 within equity, this is all equity. This is debt here. Within equity, I create a new item which is called employee comp reserve, employee compensation reserve. This becomes 1067. Then in year 2, on the income statement, I show expense. I again show expense of 1067. But remember from last year, I have some paid in capital, I have some retained earnings, and I have last year opening employee comp reserve of 1067. This is from last year carried forward. To this, I will add 1067 again. So that's the second effect, and that's how we'll keep on doing. In year 3, what will happen on the balance sheet is I have employee comp reserve. Now, after passing the year 3 entry, my total is 3200. So then I will say less the transfer to paid in capital, 3200, this becomes 0. And my paid in capital, whatever was the earlier amount, increases by 3200. Of course, I must have other amounts, right? I have to have other amounts. Is that making sense? Who asked that question? Someone asked that question, but I hope that Shala, that makes sense to you. Okay, someone is asking, so in case shares called restricted stocks and in case of options, they're called RSUs. No, are you a sir or a ma'am? Let me make a guess. No, ma'am. You are? Okay, no, sir. But I'm sure I'm not the only one who's confused that way. ESOPs are called ESOPs. Shares are called shares. Now, shares can be RSUs or they can simply be issuance of outright shares. Are you getting it? Why would we call options RSUs? Options are called ESOPs. Okay. See, my assumption is you've done work and we're doing a revision class today. Are we on that agreement here? Let me make sure I've covered all the three for you. Yeah, done. This section is done. Let's go to section number 3. Section number 3 now is on accounting for ESOPs. Now we're making good progress. I hope you guys are with me. Accounting for ESOPs. Okay. Now again, straightforward. First January 2000, you assume you plan 100 ESOPs. Okay. The fair value of the stock is 100. The strike price of the options, ESOPs are nothing but options, right? So strike price is, let's assume 80. Okay. Now, expiry of these options is let's say 5 years. I'm just making up something random. However, vesting period is 3 years. All right. So now we have to do accounting. So first thing we know is the question we ask ourselves, क्या हम एम्प्लॉय को शेयर्स दे रहे हैं या ESOPs दे रहे हैं? Are we giving shares to the employees or we giving options to the employee? Options. So then I need to figure out the fair value of the option. I need to figure out what is the fair value of the option. Accounting standards don't tell you how to use fair value, but a very standard practice is to use Black-Scholes model, BSM. So you use Black-Scholes model, or you use binomial model, or you use whatever model that you think is fit. Accounting standards do not prescribe a model, and you figure out a fair value of option using the BSM model on the grant date. Uske baad wala does not matter. Same logic. Let's say now fair value of the option happens to be 30. And you're assuming that everything will be vested. Okay. How will I do accounting for this? Now this accounting I'm going to do for you. I just want you to be with me on this. It's very simple. This is year 1, year 2, year 3, income statement and balance sheet. All right, now observe carefully. What I'm going to do is I'm going to figure out what is the total fair value of these ESOPs on the date of grant. Any subsequent change in the value does not matter. So fair value on the date of grant is 100 into 30. How much? 3000. Same. Income statement, year 1 expense 1000, year 2 expense 1000, year 3 expense 1000. Are we paying cash to recognize this expense? No. We're just giving them ESOPs, right? So second effect, employee comp reserve. This reserve is created where? In balance sheet as a part of equity. Employee comp reserve first year 1000, employee comp reserve second year 1000, employee comp reserve third year 3000. Okay. Now the year 3 accounting treatment is a little different. Let's keep expiry also 3 years just so that I can show it in this example itself. Do they usually provide fair value of the option on the exam, or we calculate? No. The fair value of the option is given. You are not expected to run a Black-Scholes model there. And for that, they'll have to give you a normal distribution table that will be too messy. I don't think that would be required. They'll give you a fair value of the option. All right, now everyone focus here. After this, it's a little technical. Now I'm assuming that exactly at the end of year 3, all these employees came and listen to me carefully. They said, sir, please take this strike price. Please take this strike price and now you give me shares, right? This is where it's different, because when we gave restricted stock units, or when we gave shares, or when we gave phantom stocks, all of that, did employee give us any cash? No. But in case of ESOPs, employee will give you some amount of cash. Correct? What amount of cash is that going to be? That's going to be the strike price. So the way you're going to do the entry at the end of year 3, step number 1, employee comp reserve 3,000 less transfer to paid in capital 3,000. First, you make this reserve 0 and you transfer that money to paid in capital. But that's not sufficient. Second effect, cash received. How much is the cash received? So we have 100 ESOPs and strike price was 80. So employee will give us how much cash? 1,000 into 80? 8,000. So cash received 8,000. Second effect, increase in paid in capital 8,000. That's how your balance sheet will tally. So think about it from a balance sheet perspective. First entry is very simple. You're just transferring from one head to another. See, this is my balance sheet equity head, right? So I have paid in capital some amount. I have retained earnings. Then I had employee comp reserve. That amount was 3,000. I deducted that. I transfer that amount here. Done. Job simple. Second effect, cash received 8,000. Paid in capital increases by 8,000. Job done. That's my accounting for ESOPs. What about the shares that we issued? That is the reason why your paid in capital is increasing. Why is your paid in capital increasing? Okay. My simple question to you. Let's do basics. Are you finding this difficult? Let's do very fundamental. If a company comes and company issues shares for cash, like they're running a IPO, maybe they issue more shares to the shareholder, they get cash. How will you do accounting for it? Cash will increase on the asset side, and on the equity side, shares will increase. Same thing is happening here, but instead of issuing shares to public, we are issuing them to employees. Some part, that employee compensation reserve, I transferred to paid in capital. Plus I received some amount of cash from employees. So my cash increases and my paid in capital increases. Correct. The number of shares will increase. Why is there a ECR of 3,000? Did you deduct? Ye strike off hai. In my handwriting, this was supposed to be a strike off. Ishita. What is employee don't exercise the option? It's an accounting assumption, dear. Again, if for example, let's assume third year, none of the employee came to me. Okay, then what will happen? If none of the employees came to me, that ACR will remain on my balance sheet till the time these employees don't come for exercise of shares. Let's say वो employee को 10वें साल में याद आया, employee remembered it about 10th year, and assuming that options are still to be exercised, hypothetically, if that was available, then you would say, okay, fine, then I will pass this entry in the 10th year. So this entry of transferring ECR and increasing cash, this is passed whenever employees come to you to exercise. That is the entry for exercising the option. So expiry agar 3 saal ka hai, then it's not possible. But what if vesting is 3 year, but let's say expiry is 10 year American, that you can exercise anytime between 3rd year and 10th year. Then whenever employee comes, I will pass this entry. If half of the options are exercised, I will deduct half from the ECR. That's correct. You're getting it now. It's all proportionate, no? It's on a per share basis. So if less number of employees come, I'll deduct less number of value. That's okay. Easy? Why do we use fair? Ishan, I don't care. I mean, I can give you an answer, but why do we use fair value? Because accounting standards ask you to use fair value. I think it's it's a very fair thing to do, because when I'm giving options to my employees and I'm telling them, boss, this is stock is worth 100 today, you buy it from me at 80. If that option was available in the financial market, will it be trading at 20 or more than 20 with a 3-year expiry? Definitely more than 20, right? So when I'm using fair value, I'm essentially trying to replicate, had this option traded in the market, at what price it would have traded, because that's the amount I'm giving free to the employee. So that's the amount that should be my expense. That's it. What if option expiry? This is becoming a main session now. What if option expiry after vesting period settlement is क्या लिखा है पता नहीं भाभी को क्या लिखा है. What if option expiry is after vesting period settlement is done on? I just explained, no? This last entry you pass when the options are settled. That's it. When employee exercises the option, should we consider cash received as income? No, ma'am. Why would you consider cash received as income? Fundamental accounting concept, revenue, nature transaction, capital account nature transaction. When you receive cash for issuance of shares, those are capital nature of transaction. That is not your income. If expiry was in the 5th year, we'll simply pass 8,000 entry in the 5th year. Yeah, 3,000 entry. Yeah, you're right. Both 3,000 entry and 8,000 entry is passed in the 5th year. See, this entry, no, these two entries, they're passed when options are exercised. It's as simple as that. Okay. All right. I hope you guys are with me on this. Some theory I need to cover now. Here's what a typical question writer on the level 2 exam really loves. Even curriculum discusses this. They say, what if volatility on the date of grant, was higher than normal? Then what will happen to the option price? That means ESOPs. And therefore, what will happen to your expenses? And therefore, what will happen to your P&L? Okay. So if volatility is higher, option prices are higher. If option prices are higher, come on, everyone, I want all of you to participate. If option prices are higher, then expenses are higher. If expenses are higher, then my profit is lower. So the question could be on, imagine they would say something like that the company made a volatility assumption of 3%, but maybe they made an incorrect assumption. Everyone else in the same sector was making a volatility assumption of 5%. Had the company used 5%, what would have been the impact on their profit? Your answer is impact on the profit would have been lower. Now, if I were writing the question, I would put something like this to trap the Suman tax ke liye do patience rakho thoda. If I were writing the question, here's what I'll do. What if volatility after the grant date is higher? Okay, now typically the way we are wired to solve these questions is we look at volatility, we immediately, because we've done this in level 1, हम लोग सोचते हैं अच्छा volatility higher, option price higher. But look at the language, volatility after the grant date. If volatility after the grant date is higher, what happens to the ESOP option price? No impact, I don't care, no impact, no impact. Because we don't care about option prices after the grant date. So be on the lookout for these language plays at level 2, right? They do a lot of it. So when you're reading the question, please remember this mantra. Read the, should I use that word now? Question carefully, right? Be super alert when you're writing, because there are these language plays on the exam. Okay. What if RFR on grant date is higher? If risk-free rate on the grant date is higher, then option price is, remember, ESOPs are always call options. ESOPs are not put options. You're not giving put options to employees. That would be weird, right? So if imagine if you were to give put options to employees, employee क्या करेगा? काम नहीं छोड़ेगा. काम नहीं करेगा नहीं. They will think of how can I destroy the value of this company sitting in the company. So if RFR is higher, this is higher, this is higher, this is higher. Correct? If no, my mistake. Profits are lower. If time for expiry is given longer to employees, instead of vesting period is still same, but you tell them, you know what, if you want to exercise, you can exercise anytime after 3 years till 10th year. You give a long expiry window. Then time to expiry higher, ESOP higher, then expenses higher, and therefore profits lower. What if, what am I forgetting here? Take variable again, spot price to show low. What if the dividend yield assumption is higher? Then if dividend yield is higher, come on, what is the impact on call option? Call option value is lower, thank God, and therefore expenses lower, therefore profits are higher. So just be on the lookout for these assumption type of questions. This is from level 1, the variables that affect option value. All right, we're done. One small point I want to do. In this previous example, when we receive this cash from employees, this is the first time your cash flow statement will be affected, because everything that we were doing till now, there was no impact on cash flow statement. I was just giving shares free. But this is the first time I'm receiving cash. So this will have impact on cash flow statement. Will it be CFO because we're paying salary to the employee? Or will it be CFI because it's just school? Or will it be CFF because employees are buying shares? Where do you think this is an inflow, right? Cash received. Where do you think this should be shown? This should be shown in no, it's a actual cash received from employee. No, you are my employee. You gave 8,000 to me. I gave you shares. Now I've received 8,000. So I have to show that as a cash inflow somewhere because my cash has gone up. CFO or CFI or CFF? It should be CFF because you're receiving cash by issuance of shares. In this case, employees are exercising the options, but that basically means they're buying your shares. Correct? So that has to be cash flow from financing activity. Again, be mindful of that. Are we all together? Are the spirits high? Can you give me a loud I pass? Yeah, thank you very much. In the chat box, good. All right, so 3 sections done out of 8. Now we jump on the 4th one. This is where it gets a little complicated. Section number 4 on tax windfall or tax shortfall. Now what is this? Let me show it to you. Observe carefully. Imagine I issue, this is 1st of January, year 2000. I issue 100 RSUs. Fair value at the time of issuance was 30. Okay. Vesting, let's say in the 3rd year. Okay. However, settlement in the 4th year. Settlement means actually issuing the shares. So this is year 2000, 2001, 2002, 2003. The value of the shares at the time of settlement, was, let's make it 100 rupees. The value has gone up quite significantly. Okay. Now see what is going to happen. This is my accounting expense and this is my tax expense. All right. Accounting expense in year 2000, 1000 into 30 vesting over 3 years. That means straight line. First year accounting expense 1000. Second year accounting expense 1000. Third year accounting expense 1000. Fourth year accounting expense 0. Tax expense. What the tax babu will say, what the tax officer will say, they will say, I understand you're creating accrual accounting of system. You gave those shares to the employee because you wanted them to work for 3 years. So you're using accrual logic. Therefore, you're showing expense of 1,000, but the shares are not given to employee yet. So as a tax authority, I'm not going to allow you to take the benefit of some expense that's not happened in reality yet. It's just khayali pulav, right? It's just accountant's imagination. So year 1, no expense allowed towards employee comp. Year 2, no expense allowed. Year 3, no expense allowed. But now in year 4, when the accounts are actually settled, you go to the tax guy and you say, okay, sir, you did not allow me the expense, but now I've actually given shares. And now the value of the shares that I've given is actually 100 shares. And now at the date of settlement, the value was 100. So you should allow me expense at 10,000, right? At 100. So year 4 on the tax account, you're going to get expense of 10,000. Now suddenly what will happen is you got a much more larger expenditure in the taxation book. Therefore, in year 4, you will reduce your tax liability, correct? Significantly. Do you agree with this? You have to pay a very less amount of taxes in year 4. Let's assume tax rate is 30%. Tax rate is 30%. So technically, you're getting a tax benefit of 3,000 in this year. Let's make the tax rate 40%, so you're not confused with this number. Let's make it 4,000. You got tax benefit of 4,000, whereas as per accounting expense, your tax benefit is only 1,200. 3,000 into 40%. So बहुत फायदा हो गया, right? See, in simple language, if I get more expenses, I'm happy on the tax book, because higher expenses means lower profit. Lower profit means I have to pay less amount of taxes. This is referred to as a tax windfall. So when do you experience windfall? When the share price goes up. In our example, share price went from 30 rupees to 100 rupees. So it gave me a fantastic tax benefit. I experienced a tax windfall. Okay. When will I have a tax shortfall? If the share price in this window had fallen dramatically to 10. If the share price had fallen dramatically, then I would have received expense of only 1,000. Then it would be a tax shortfall. So tax windfall versus tax shortfall. Have you understood what the concept entails? Windfall versus shortfall. Okay. Now, extremely important. Same stuff. Yeah, tax benefit is windfall का मतलब होता है आपकी दादी गुजर गई, आपके लिए मोटा नोट छोड़ के गई, उसको बोलते हैं windfall. लॉटरी लगना है ना. Windfall basically means someone left you a lot of cash, you got lucky, something nice happened to you. That in finance we call it as windfall. RSU is restricted stock unit, like it's like giving shares to employees. I think you missed the earlier part, Shakil. We discussed that a little earlier, sometime back. Okay, now if you've understood this, what I'm showing here is extremely important. So you have to have good grip on what I'm showing you here, because now this is going to be the first instance where IFRS and US GAAP accounting treatment. Parth is saying shortfall means dadi loan chhod gayi. Yeah, sure. Why not? That's some dadi to have. Okay. So IFRS and US GAAP. Now, if you have a tax windfall means benefit. When is that happening? That's happening when settlement price is greater than grant date price. Yes. Tax shortfall, settlement price is very low. It has fallen dramatically compared to grant date price. Okay. Now, what IFRS says you receive tax benefit. Your tax cash payout has become low. Good for you, but you've not earned it. Your share price went up. That's a shareholder transaction. That is not company's performance. It should not come on the income statement. So what IFRS recommends is you bypass P&L, you bypass income statement, and all the benefit that you have got, you directly take this benefit to equity section under OCI. If you have losses, IFRS is fair. IFRS is fair enough. It's not your problem that you had losses. It's not you that caused the stock price to fall, is the market. I mean, it's a shareholder transaction. It's not about company's performance. So you bypass income statement, you directly transfer those losses to equity. So whatever benefit or losses that you get because of this windfall, those are not put in the P&L, those are put into equity. What US GAAP says is, US GAAP says nothing. US GAAP says you do accounting the way you want, which obviously means the benefit goes to income statement. Okay, now let's show you very quickly what that means. Income statement, how does that benefit goes to income statement? This year's tax expense will fall dramatically because this year my expense will go up. So the amount of tax that I need to pay will go down. So my tax expense goes dramatically. At the end of the day, this year's profit will go up. This year's return earning will go up. Eventually it's going to equity. This is also going to equity. But in one case, you're bypassing P&L, you're transferring it directly to equity. In other case, you're routing it through P&L. At the end of the day, equity is increasing in windfalls. But in one case, it's happening because in one case, you're recording it in income statement. So tax expense will go up. Because tax expense will go up, think of this effective tax rate formula. How do you calculate effective tax rate? Effective tax rate will be tax expense divided by profit before tax. Now, if your tax expense has gone down, your effective tax rate will go down. So what US GAAP does, very important, so important that I'm going to increase my font size. If this, under US GAAP, this accounting treatment creates, I hope you're listening, it creates a volatility in effective tax rate. Why? Because some year I will have a windfall, some year I will have a shortfall. It's affected by market price of the stock. Markets are volatile, right? So there are instances where my stock will fall. There are instances when the stock will go up at the time of settlement. This will cause my income tax expense to vary. This will create volatility on the effective tax rate, but that will not be the case in case of IFRS. Coming back here, same treatment. If there's a tax shortfall, then you will say this goes to income statement, and because of income statement, what happens now here, your tax expense proportionately goes up, and if your tax expense goes up, your effective tax rate goes up. This is what you need to know for the tax windfall and shortfall, nothing beyond this. You do not have to get into whether we create a DTA, DTL, all that nonsense, leave that in level 1. Here, it's extremely simple. What did we learn? Let me do a 2-minute recap for you. For accounting purposes, I do accounting based on the fair value on the grant date. But for tax purposes, I do accounting based on fair value on the settlement date. So these are my accounting expenses. This is my tax expense. Now my actual tax expense could be higher or lower depending on how the stock prices have moved. If the stock price was higher, tax expense is higher. Tax expense is higher, then effective tax rate lower. In US GAAP, if the actual stock price had fallen dramatically, then my tax expense is lower. My expense is lower. Expense is lower, tax expense is higher. So effective tax rate will go up under US GAAP. It will not have any impact on IFRS. Why is this important? Curriculum is given a meta example. And what curriculum says is that there was a phase when meta stock fell down by 71%. So when the meta stock fell down by 71%, what do you think would have happened to their effective tax rate? Now Meta is a US company following US GAAP. So effective tax rate must have gone up, right? So if you're doing some sort of a financial modeling, okay, and you're looking at effective tax rate, what do we tend to do generally? How do we model effective tax rate? We make that as an assumption. I generally take last 3-4 years effective tax rate. I say, okay, it looks like company is paying in this range. I assume that for the future. But in this case, you got to be careful about that because this increase in stock price can have impact on effective tax rates. This is what you need to know. And if you know this, then we are through with this section. Can you give me a I pass or I struggle on this? Okay, I think I've covered everything that you need to know. Tax windfall, nahi yaar, abhi just windfall matlab fayda. Rahul is asking, is tax windfall increasing the effective tax rate? Tax windfall means I have a benefit, so I have to pay less taxes. So that will reduce effective tax rate. A tax shortfall means I have to pay more taxes. So that will increase my effective tax rate. Just think of it as windfall means benefit to the company, not to the tax department. Benefit to the company, so they have to pay less amount of taxes. That's it. Section number 5 on this now. All right, this is a heavy one. Are you all with me? Can you give me a large, loud I pass before we start? All right, Prinka, love the enthusiasm. Thank you, Shala. Good. All right. Okay, so here we go. Section number 5 is on treasury stock method. Now, what is this? What is this about? This is about EPS calculations. So remember from your level 1, EPS is calculated as profit divided by number of shares. Now these EPS that we calculate, we can have two types of EPS. We can have a basic EPS or we can have a diluted EPS. Correct? Primarily what happens is there is some impact on numerator, but in case of diluted EPS, the number of shares goes up because the firm has issued some potentially dilutive securities like convertible bonds, convertible preferred stocks. We don't care about those two here. But one important dilutive security is ESOPs, and we care about ESOPs here. So the level 2 curriculum focus is on, because of those ESOPs, the number of shares will go up as a denominator of diluted EPS. How do you calculate those number of shares? So that's where we use a treasury stock method. Okay. Now, I'm going to do two examples here. One example which is really simple so that we understand what's really happening. And then second example which is at CFA level 2 level where we have to do some technical adjustments. Okay. So all of you be with me on this. Here's example number 1, the easy one. Let us say a company has a profit after tax of 100. The number of shares that they've issued is 10 common shares, and number of ESOPs that they've issued, okay, employee stock option plans, are 10. The exercise price of these options is, let us say, 80. Right? Average market price during the year is 100. Now, only based on this information, we have to calculate basic EPS and we have to calculate diluted EPS. Okay, I'm going to do this for you. I just want you to observe carefully. Here is a basic EPS. I will say straightforward. I have a profit of 100. I've issued 10 shares. Profit of 100. What is the basic EPS? 10. Now, diluted EPS will always be lower than basic EPS. So here I will say profit after tax 100 divided by number of shares 10 plus 10 plus something. What is that 10 plus? So this is where we run, okay, this is where we run a what if scenario. If you want to truly understand this, you need to be extremely vigilant now on the session for next 2 or minutes. This is a what if scenario. The options are not actually being exercised now. We are asking ourselves, what if the options are exercised? Okay. So here's what we do. This method that I'm showing you now is called treasury stock method. Okay. It works like this. Step number 1, you assume that ESOPs are exercised by your employees. Okay. And therefore, 10 shares are issued to employees. So my number of shares will increase by 10. Are we together here? 10 shares are issued to the employee. Step number two, extremely critical. The exercise amount is received by the company. Correct? If employees are exercising, exercise amount is received. That means 10 into 80, how much? 80 is the exercise price, is that correct? 80 is the exercise price. So the total amount received, 800. Have you received this in real life? Have you actually received 800? Yes? No. This is a what if scenario. What if employee had exercised them today? Then employees will give me how much? 800. This 800 is called assumed proceeds. Assumed proceeds. Okay? Now know this word. What is assumed proceeds? For the timing, it is simply number of shares into exercise price per share. When we go to the level 2 level of example, I'm going to expand on the assumed proceeds definition. It will have cash received plus something. Okay, but for the timing, it is simply cash received, nothing else. Okay, if this is done, then in step number 3, extremely critical, the reason why it's called treasury stock. What does treasury stock mean? Treasury stock means what? Hitesh. Come on. Treasury stock means what? That's correct. Treasury stock means buyback, right? So assume that this 800 is used by company. Company says, here we don't want this money. We're going to use by the company to buy back shares from open market. It's an assumption, it's not really happening, at average price. If I have $800 with me and average price of the share during the year is how much? 100. So how many shares do you think I will be able to buy back? 8 shares. I will be able to buy back 8 shares. So my total shares, net shares issued. Okay, I'm coining this own term. This is my own term now. Net shares issued, like how many shares have I issued? I issued 10 shares here, but I bought back 8 shares, right? So net shares issued is 10 minus 8, 2. This 2 will be added to the denominator of the diluted EPS calculation. So now diluted EPS will become 100 divided by 12. Okay. These 12 are called total number of diluted shares, all of them. So these are called basic shares and these are called diluted shares. So here diluted shares are 12 and then whatever EPS I get, how much is this? 8.33. This is my diluted EPS per share, lower than basic EPS per share, job done. This method is called treasury stock method. Have you understood this? Step number 1, assume ESOPs are exercised, 10 shares are issued. Step number 2, assume proceeds is equal to that exercise price and then use that money to buy back the shares. So you have the net number of shares that you want to add here to the denominator. Okay. If you've understood this, here is the level 2 level of example now. Everything is same. The only technical difference is that your assumed proceeds is equal to amount received from employees. Amount received from employees. How is this amount calculated? Number of ESOPs into share price, strike price. Right? So this is same. This we know, assumed proceeds, that means how much money. But in the level 2 curriculum, they throw in one more additional component to it. And they have a rationale to it. it took me a lot of time to figure out why that second component is added. So let me explain now, see if that makes sense. So think of it this way, that I issue ESOPs today, okay? The vesting period is 3 years. So my ESOPs are going to vest over a period of 3 years. So 3 years I'm going to recognize expense. At the end of year 1, I'm running a what if scenario. What if the options are exercised now? Okay. If I assume a what if scenario at the end of year 1, then if options are exercised at the end of year 1, then will I incur any expense for year 2 or year 3? If the options do get exercised year 1 itself, I'm running a what if scenario, no? So under my scenario, if the options are exercised, then year 2 will I have an expense? No. Year 3 will I have an expense? No. So what the curriculum says is, then in that case, the amount of expense that you otherwise would have had, right, which is called as an unrecognized comp expense. So what you do is you use also that money to buy back, because you're not having those future expense. So you might as well use that money to buy back now. So your assumed proceeds is made of 2 parts. One, amount received from employee. Second, average unrecognized. That means I have not recognized this in my books yet. I was going to recognize this in the future. Average unrecognized comp reserve. Average unrecognized comp reserve. That means the expense that I was going to have in the future because of this issue, I take an average of that, and this is comp reserve, not comp expense. Unrecognized comp, I'll show you the calculation. I will take an average of that, and I will also add that to assume proceeds. If you got this treasury stock nonsense in the level 2 curriculum is done. I did spend a lot of time on the accounting, the original accounting standard, both US GAAP and IFRS, and the treatment is consistent. This is what, both of them require you to do. Yeah, you will not understand this now. You will not. Okay, but you will understand once I do the example. But just know average unrecognized comp reserve. Now, what is the definition of average? Definition of average is opening plus closing divided by 2. That's an average. Okay, let me create a super simple example so that you understand what I'm trying to say. Let us say this is 1st January 2000. We have issued 100 ESOPs to the employee. The strike price is 80 rupees. The spot price, that means the share price on the date of issuance, was 100. Option fair value, according to Black and Scholes model, is 30. All right. Now I have to do accounting for it today. How will I do the accounting? So this is year 1, year 2, year 3. Year 1, remember this is year 1 end. My accounting expense is going to be 100 ESOPs into 30. Total is how much? 3000. Year 1 accounting expense is how much? 1000. Year 2, 1000. Year 3, 1000. Okay. What is the employee comp reserve? That means how much money is, what is the second effect of employee comp reserve? First year employee comp reserve 1000. Second year 2000, because it's a balance sheet item, so it accumulates, right? So 1000 plus 1000. Third year 3000. Now you don't record this number that I'm writing here, but you can calculate this, which is unrecognized comp reserve. What is unrecognized comp reserve? Unrecognized comp reserve means how much of my expense, because of options that I've already issued, will be coming in the future, but I have not recognized yet. Okay. So total expense over a period of 3 years is how much? 3000. Out of that 3000, first year you recognized how much? 1,000. So how much amount is yet to be recognized? 2,000. That is called unrecognized comp reserve. Are you getting hang of it? Second year, total expense is 3,000. Till date, I've recognized how much? 2,000. So how much is left? 1,000. Third year, total expense is 3,000. I've recognized how much? 3,000. How much is left? 0. This is unrecognized comp reserve. I have to take an average of these amounts, and that average of these amounts will go in here. Okay, so I'll do an example for you so you'll understand. So now, if up to this is clear, let us say at the end of year 1, the stock price has gone up heavily. It has become 200. Okay, now calculate diluted number of shares at the end of year 1. So here's the answer. Diluted number of shares is equal to common shares issued plus net shares due to ESOP plan. Common issued shares, I haven't given you in this example. We don't care. Like maybe number of shares were, let's say 50. Number of shares, let's say 5,000, whatever, right? So then 5,000 plus this number. This number, if you attended classes with me at level 1, I used to call it as X for that shortcut formula, right? So this X, this is what I need to find using treasury stock method. Okay, are you with me? Same 3 steps. Number 1, assume ESOPs are exercised by the employee and shares are issued. How many shares did you issue? How many ESOPs? 100. So 100. So number of shares issued 100. Step 2 is my assumed proceeds. Assumed proceeds, that means how much money I've received. This is actually coming from 2 parts. Number 1, money received from employee plus average of unrecognized comp reserve. It's going to be of 2 part. Average of unrecognized comp reserve. Employee will give me how much? They're buying 100 shares. They're buying the shares from me at what price? 80 rupees. Remember, that was a strike price. Shala. Strike price is 80. So employee will give you 80 and they will say, hey, I have a strike price of 80. Please give me the shares, right? So 100 into 80. How much is this? 8,000. But now the logic is that, boss, at the end of year 1 itself, you're assuming that you're assuming that shares are exercised. That means in the future, I don't have to show those expenses. So whatever is the unrecognized comp reserve today, which I was going to show as an expense in the future, I can use that money also to buy back. Yes, but we have to take an average. I can't use this 2,000 as it is. So I need to know what was this is the closing balance of this year. What was the opening balance? Opening balance was 0. Punita, no. You are not taking average of year 2 and year 1. You are at year 1 today. So year 1 value is the closing value. What was the value last year? It was 0. Why is it 0? It's a new plan. Last year I did not have any unrecognized expense. So what is an average of 0 and 2,000? Average of 0 plus 2,000 is 1,000. So my assumed proceeds is going to be 9,000, not 9,000. I request don't put anything on the chat box till the time I don't finish. I just don't want to lose the rhythm. So assume proceeds 9,000. When we studied the same topic at level 1, we just took assumed proceeds at 8,000. But at level 2, they bring in this technical adjustment. And I think it's fair. Initially, I thought this was stupid because the curriculum does not explain why. Right? But when I dig through the literature on this, on accounting standard, I understood what's the logic. The logic is that if I'm truly assuming what if their exercise, then I should also assume that in the future I'm not going to show an expense. Their exercise today itself. So that expense that I'm going to show in the future, which in this instance is 2000, I should also use that amount to buy back the shares today. So therefore I should buy back an average of this 1000 and this 8000. That's how I get my 9000. And if you've done this, then step number 3 is easy. So what happens in step number 3? So in step number 3, number of shares that you're going to buy back with this money, with the amount that's available at your disposal is 9000. Okay. And what is the average price in the market in the second year? Sorry, in the first year, average price is how much? Did you? Did I? Yeah, I gave you. First year average price is how much? 200. Okay. So average price is 200. So the number of shares I can buy back is 45. Okay. And then net new shares is these 100 that I issued minus 45 that I bought back. This is going to be 55. These are the net new shares issued. So my total number of diluted shares will be 5000 plus 55, 5055. This is that treasury stock method. What do you think? What about 1000 of year 2? Year 2, we again show 1000 as expense. Actually, this is a what if scenario. This is not actually happening. Okay, what about year 2? So year 2, what will be the average unrecognized comp reserve? It will be an average of 2000 and 1000. It will be how much? 1500. In year 3, what will be an average? 1000 and 0, 500. This accounting, they're trying to smooth out. See, like what's happening in practice, Ayesha thinks she's saying, why are we taking average? Because we are creating a smoothing effect. You're not issuing ESOPs just once and not doing it again. You're going to have new ESOP plans every year. So obviously if you've issued new ESOPs this year, your unrecognized comp reserve will bump up this year, but you did not have it last year, right? That's why you're averaging it out. Why not use present value instead of average? Why should you use a present value? Makes no sense to me. I mean, if I'm buying back today, I'm buying back today. That's, it's simple. How many years we should reduce record accounting expense if ESOPs are not? It doesn't matter if ESOPs are exercised or not. My accounting expense is over vesting period. We discussed that at the beginning of the session today. Okay. You know what? We should do one more example. Should we? On the same topic so that you get comfortable with this. All right. So let's say the firm has basic shares, okay, of 100. Number of ESOPs are 50. The strike price of these ESOPs is 30. Spot price that time is 50. Fair value of ESOP according to BSM model. I'm intentionally throwing BSM again and again so that it gets drilled into you that we don't do accounting on intrinsic value, we do accounting on fair value, which is going to be more than that. So let's keep this at 30. Vesting period 3 years. Vesting period 3 years. Okay. Now here's super interesting thing. Stock price schedule. Okay, time 0, time 1, time 2, time 3. Stock price is here at 50, which is consistent with this. In year 1, we will assume 2 scenarios just for practice. Stock price becomes 200 versus stock price becomes 10 rupees. Just so that we learn something out of it. And in year 2, let's assume stock price has become 300, and year 3, let's assume stock price has become 400. What I want you to do is just calculate diluted number of shares for each of the year. Diluted number of shares for year 1, year 2, year 3. If you want to create a table and do a tabular calculation, that's also okay. That was fast. How about online? Are you guys done? Mohit, Shala, Pranshu, I'm waiting for you. Aisha, Girish, Chirag, Parth, come on, where are you? I hope you're with me. Okay, let's do this together. So I'm going to first create a table. This is year 0, 1, 2, 3. Accounting expense going to be a straightforward 50 into 30, 1500. So first year 500, second year 500, third year 500. Then employee comp reserve. Again, one more time, where does this number go? Employee comp reserve, where do we show it? Balance sheet equity side. First year 500, second year 1000, third year 1500. Unrecognized employee comp reserve, which is like some sort of a future expense that I'm going to recognize, right? First year, this number is obviously 0. Year 0 is 0, but in year 1, see, my total expense is 1500. Till date, I've recognized 500. So how much is not recognized yet? 1000. How many of you got this part right? Can you give me a I pass on the box or I struggle? How many of you got the 1000 part right? That's great. If you're getting this, then fantastic. Then second year, I've recognized 1000 till date. How much is unrecognized? Krishna, second year, I've recognized total 1000, right? 500 plus 500. How much is unrecognized? 500. And third year, I've recognized 500 till date. How much is unrecognized? 0. So now I have unrecognized comp reserve for each of the year. Now let's build another schedule for diluted shares. So this is year 1, year 2, year 3. Basic shares. Basic shares means your common shares that you issued. Basic shares are 100, so obviously they remain 100. Okay. Then number of ESOPs issued. That means number of shares against ESOPs. Number of shares against ESOPs issued. So we have how many ESOPs? 50. So we assume, okay, all the 50 are issued, right? Then third, assumed proceeds. Assumed proceeds. Okay. Now in assumed proceeds, we will make two parts. Assumed proceeds. We will make two parts. One is cash received, and second is average unrecognized comp reserve. All right. My apologies for my handwriting, but I think it's too late for me to change in this lifetime. So cash received. How much is cash received? Your employee will come to you and say, hey, please take these ESOPs and take this strike price from us, right? Strike price of 30. We'll give you this 1500. Please give us a share. So cash received from employee, 1500, 1500. That doesn't change, 1500, right? But average unrecognized comp reserve, when I'm in year 1, I'm going to take an average of these two numbers. So that's going to be last year opening plus closing by 2. That's the formula, opening plus closing by 2. So average unrecognized comp reserve 500. How many of you got this part right? Did you get this right? That's a good job. Okay. If you did, fantastic. Okay. Then second year, I'm going to take an average of these two, right? So that average will be how much? 1000 and 1500 average, 750. Third year, I'm going to take an average of opening and closing. This is closing, this is opening. How much will that be? 250. So these are my assumed proceeds. Assumed proceeds of 2000, assumed proceeds of 2250, assumed proceeds of 750. Now, number of shares bought back. Okay, ideally I need one more column for net shares. I'll just create that here itself. Number of shares bought back. I have $2,000 with me divided by, I have $2,000 with me divided by, at the end of year one, the average price, two scenarios. Right now, let's just stick to 200. Okay, let's stick to 200 for the timing. So 2000 divided by 200, how many shares will I buy back? 10. So then I've issued 10 shares, but I've I've issued 50 shares, I've bought back 10 shares. If this number is A, this is B, and this is C, then your final calculation would be A plus B minus C. Is that correct? So that will be how much? 140. Then next year, number of shares bought back 2250 divided by year 2, what's the price? 300. So 2250 divided by 300. How much is that? 7.5. So then the number of shares 150 minus 7.5, 142.5. Next year will be 1750 divided by stock price is 400. So I'm buying them back at 400. How many shares? So 4.375. So now you're left with 145.625. 145.625. And if you've understood this, then great job. You've mastered this section. Now you know how to deal with these. What do you think? Someone is asking, how can employee exercise ESOP in year one when the vesting period is 3 years? What answer do you want to give to them? Correct. And the chat box, can you give answer to Aditya? What if Aditya is asking, how can employee exercise in year one when vesting period is 3 years? What is the answer? It's a what if scenario. Is this really happening? No, it's a what if scenario. Okay. Now, if I were writing a question for you, I would assume that if you're a level 2 candidate who put in serious efforts, you know how this thing works, right? What I will do is I will construct my question on this part, because then I can filter out candidates who've done some more nuanced work. So I will say, what if the share price in year one actually is only 10 rupees? That means the stock price has fallen dramatically. Agree? Because something very interesting happens in this situation. If the stock price has become 10 rupees, okay, all of you please be with me, then what happens? Then the number of shares I buy back, is this year one? Yeah, year one. The number of shares I buy back, at 10 rupees, I'm going to create a mess here itself. I don't want to create a separate table. How many shares? I have $2,000 with me. Stock price is $10. How many shares can I buy back? 200. So I can buy back 200 shares. So then my net becomes 100 plus 50 minus 200. This is how much? Minus 50, which is weird, right? In fact, the rule is, if the number of shares you are buying back is more than, forget this basic, if they're more than the number of ESOPs issued. And when will that happen? No, it's a possible scenario. When will that happen? That will happen if stock price has fallen dramatically, where you can buy back more. Then we will say that the shares are anti-dilutive. So when do these ESOPs are anti-dilutive? So when do ESOPs become anti-dilutive? ESOPs will become anti-dilutive when the share price has fallen dramatically. When the share price is, don't get into OTM, ATM. If the share price has fallen dramatically, then the number of shares you can buy back will be higher than the number of ESOPs issued. And you cannot allow the diluted shares to be less than basic shares. Right? That's the basic principle. In that case, it becomes anti-dilutive. In that case, diluted shares is same as basic shares, which is 100. Okay. So which means, and very critical now, because my question on the exam, if I were to write, will be on this. This is a sentence that if stock price has fallen dramatically, then the ESOPs may become anti-dilutive, and ESOPs become anti-dilutive. In that case, the number of basic shares is equal to number of diluted shares. Okay. Now, there is some valuation angle to it, but I think I'll hold on to it for a bit. We'll reach on the valuation. I'll circle back to this part when I go to my section number 7. But for the time being, if the share price has fallen, ESOPs will become anti-dilutive under this method. That's it. And when is that happening? When you're able to buy back a lot many shares, Ayesha. I will pray to God that you will not set our question paper. Yeah, I am not. When is this happening? This is going to happen when I'm able to buy back more shares with this money than what the number of ESOPs that I've issued. Okay. Now in the CFA curriculum, they have an example on the same stuff, but there they have restricted stock units and ESOPs in the same example, and you're asked to calculate a diluted EPS. You're asked to calculate diluted shares. When you have two of these instruments, RSUs and ESOPs, at times one of them can become anti-dilutive, one of them might remain dilutive. So you want to test each one of them. Correct? Now, can RSUs become anti-dilutive? Can RSUs become anti-dilutive? No. Why? So हम तो free दे रहे हैं, right? We are giving them free. So shareholder will always say, fine, we'll take them. So RSUs will never be anti-dilutive, but ESOPs can be anti-dilutive. So when you have two of them, then you want to be a little careful about the which part is dilutive, which in the curriculum example, one of them is anti-dilutive. Is this okay? And if you want to see that particular example, and if you have access, I think go and just watch the Blue Boxes videos on the FinTree portal. I have solved that particular example as well. So that will give you some clarity. All right. So that's out of our way. There is some nuanced theory I need to cover here. So you'll have to just give me a minute. I'm referring to my notes. Okay. Curriculum has a summary. I'm writing that summary for you. I've prepared some teaching notes for today's session. I'm just extracting from them. ITM options are dilutive. OTM options, anti-dilutive, generally. Okay, there are some technicalities to it, but let's just say this is true. Okay, now this is a little tricky. If stock price, just a minute back I said, can RSUs be anti-dilutive? And I said, no, I'm going to contradict myself. Even RSUs can be anti-dilutive. So if stock price is below grant date price, then even RSUs can get anti-dilutive, and I'll show you how. Okay, in fact, I made a mistake when I said that, and I'll show you how. And if the stock price is above the grant date, then RSUs are dilutive. Okay, maybe I'll create a RSU example for it. So this I will explain. Give me a minute, but one more sentence I need to throw in. I'm going to increase my font size and also use an impactful color so that you remember this. Loss-making companies. There's an example on some tech company in the curriculum. Loss-making companies, always basic shares is equal to diluted shares. So this calculation is not required for loss-making company. If you're a loss-making company, basic shares, diluted shares. Let me explain this part first. It's very simple. Think of it this way. Imagine there is a company which has a net loss after tax of 100. Okay. Basic number of shares 10. Let's assume dilutive number of shares. Let's assume, here, it's not possible that these are more, but let's assume they're 50, just for the sake of argument. Then what will be my basic EPS? My basic EPS will be minus 100 by 10, minus 10. What would be my diluted EPS? Minus 100 divided by 15. How much is that? Correct? Dasek number 6.67. Which number is higher of the two? This is a higher number. And if it's a higher number, then this is not possible. Why is it not possible? Because it's breaching the very definition of what diluted EPS is. What is the definition of diluted EPS? Lesser than basic EPS, but negative 6.67 is more than basic EPS. Therefore, this is not allowed. Therefore, this will not work. Therefore, in loss-making companies, you don't even do this calculation. So if you're an accountant and you're responsible for computing these shares, and this year if your company has reported losses, you should be happy. Why? Because you don't have to do that diluted shares calculation. You know basic shares are same as diluted shares. Is this understood? Okay. Now, I need to get back to that RSU, but I need to attach one point to it. An analytical question. Okay, this is where questions should be thrown on the exam, like at least in my opinion. Let us say I'm doing a FCFF valuation for a company which is currently loss making. Let's say FCFE valuation for a company which is loss making, but I've prepared a 20-year very nice forecast. I'm living in my own modeling world. Company is loss making today, but I'm expecting in next 3-4 years they will be profit making. Okay. Now, present value of FCFE, value of equity by the way, is let us say total 100 million. Now what I do is I go to annual report. And in the annual report, the company this year has made losses. So it shows basic shares, number of shares 1 million. Okay, it shows diluted shares 1 million. Now, when you do valuation of a company, you want to do valuation divided by number of shares. Should you use basic or diluted? You always use diluted number of shares. So here you would say, okay, fine. In that case, 100 million divided by 1 million, value per share is how much? $100. If you do this, this is a mistake. Why is that? Because as from a valuation perspective, this number is not representative of true diluted shares in the future. Why is that? Why is this number not representative? Because the company is making losses today, but very soon the company will make profit, and suddenly now you are not doing this diluted EPS calculation because of that simple concept that you are not allowed to go DEPS higher. Suddenly you'll have to do the calculation, the share will increase. CFA curriculum recommends you make an estimate of those number of shares today itself when you do the valuation. Will you be required to do it on the exam? No. You will not be required to estimate this, but are you required to know this concept for an analytical question? Yes. So I'm repeating this one more time so that you don't lose grip on it. I would be really happy to see a case study on this parameter. They say, and again, they give example of some tech companies in the US. Typically, these tech companies make losses for 2-3 years, then they become profitable, like a classic IT product company. What I do is I build financial model. Right now they are loss making. I build financial model. I do free cash flow to equity. We know the formula. Right? We memorize the formula. I take present value of the free cash flows. I have total value of the equity, not per share. Value of equity, let's say $100 million. I want to know value per share. So I should divide with diluted number of shares. So I quickly go to annual report. I don't think much. I look at the diluted number of shares. I put that in the denominator. My calculation is done. That valuation is wrong. Why? Because company is loss making today, the accountant did not calculate the true diluted number of shares. Had the company been profit making. So you want to calculate what if the company was profit making, then how many shares, which requires a ton of assumptions to make. That's why not in the level 2 exam. But you calculate that, and then those are the numbers you want to use in the denominator when you calculate value per share. Is this understood? Stood up. कॉन्फिडेंस दिखाते तो अच्छा लगता मेरे को. Shala is asking, when the company is making losses, you're assuming profit will increase. You cannot assume BS is equal to basic shares equal to diluted shares, just like we assumed when company is making. I'm confused with your question. Can you explain your question again to me? I don't know what that question means. If I'm repeating, if the company is making losses, when you calculate value per share, do not use the denominator as current diluted EPS. Calculate denominator as diluted EPS had the company been making profit, and use that as a denominator. Okay. Now, getting back to the RSU part, I just told you RSUs can become anti-dilutive once in a while. Let me show you how. Example on anti-dilutive RSU. Okay. Imagine you issue 100 RSU to employees. Fair value on issue date. Some random number, let's say 300. Vesting period 3 years. Okay. Now this is year 1, 2, 3. The expense that I recognize, comp reserve and unrecognized comp reserve. Okay. Now year 1 expense will be how much? 100 into 300. How much is that? 30,000. 30,000 by 3, 10,000. So expense 10,000, 10,000, 10,000, straightforward. Comp reserve, it's an accumulative item. 10,000, help me out. 20,000, help me out. 30,000. Okay. Unrecognized comp reserve, that means how much have I not recognized yet? Total expense is going to be 30. I've recognized 10. I haven't recognized 20. I've recognized 20. I haven't recognized 10. I've recognized 30. Unrecognized 0. Let's assume year 1. Okay. The stock price has fallen down dramatically to just 50 rupees a share. Okay. Now we have to calculate diluted number of shares. Sorry. So how will I calculate diluted number of shares? Look at this. Number 1, assume RSU issued. How many RSU will you issue? 100. So step number 1, assume that these RSUs, stocks are issued. So you've issued 100, not RSU, stocks. Employees got 100 stocks. Step number 2, assumed proceeds. Assumed proceeds. The money received from employee plus average unrecognized comp reserve. Correct? If it's an RSU, what is the money received from employee? 0. These are not ESOPs, right? They're not paying you strike price. So money received is 0. But this thing still remains, which is average unrecognized comp reserve. Now, this year comp reserve unrecognized 20. Last year was how much? 0. So average is how much? 10,000. So 10,000 divided by, what is the average stock price today? 50. So how many shares? So total is 10,000. 10,000. Then how many buyback I'm going to do? So buyback is going to be 10,000 divided by stock price of 50, 200. So what is the net new issue? I'm issuing 100, I'm buying back 200. What is the net new issue? Minus 100. Is it allowed to be minus? No, because that will make your diluted shares lower. So then we will say RSUs are anti-dilutive. So I'm repeating one more time. When will RSUs get anti-dilutive? If the share price has fallen significantly from the original share price at the date of grant of the RSUs. Are you with me? Have you understood this? So then that section is over. Then section number 6, we are almost to the end of it. Yes, Pranshu, you're right. Section number 6. Now we have mostly theoretical section. some of the valuation implications. I've kind of summarized this from two, three different places in the curriculum. They're scattered all over the place. Mostly theory, but I think important. So number one, when you do enterprise value calculation, okay, from valuation perspective, can you help me with enterprise value formula? Market value of equity plus market value of debt plus market value of preference share minus cash and other, right? Now, if I have a pension plan which is underfunded, if I have a pension plan which is underfunded, what is the meaning of underfunded? I have assets of 100, liabilities of 130 maybe. Then this is a liability that should be included in the market value of debt. That means I should add that underfunding as a part of market value of debt. The logical reasoning given by the curriculum is they're saying, listen, at the end of the day, it's a pension liability. At some stage, the company will have to pay. So treat this like any other liability, add that to market value of debt. However, the curriculum goes on and says that there is an asymmetrical treatment. If the plan is overfunded, then by that argument, this should become a minus item, no? But if the plan is overfunded, then you simply ignore. Okay, that's the treatment which is given. The curriculum themselves say it's asymmetric treatment. And there is some part of conservatism to it, which makes sense, right? If it's a liability, add that to debt. But if it's overfunded, ignore at enterprise value calculations. Are you okay with this point? Okay. Second point here. If it's a loss making, I covered this earlier, but I'm repeating it again. If it's a loss making company, then do not use diluted shares as it is. Do you know the reason why? If it's a loss making company, do not use diluted share as it is in valuation. I mean, see, how do you get valuation? Total value divided by number of shares. I know. So these number of shares, do not use diluted shares as it is. Convinced? Then there is one more scenario to it. There's one more scenario to it. If company's stock price has fallen dramatically, if company's stock price has fallen dramatically, then again, do not use diluted shares as it is. Because we just saw in case of RSU that if the stock price falls, suddenly these become anti-dilutive. But if you feel that, hey, this stock price fall is temporary. I told you that Meta shares fell by 71% 1 year, right? So their diluted number of shares will reduce because a lot of securities will become anti-dilutive. But next year when the stock price hopefully goes up, suddenly the number of shares will increase. So as an analyst, you need to be mindful. In two situations, you cannot use diluted number of shares and denominator of your valuation formula. What are the two scenarios? Number one, if it's a loss-making company, or number two, if the stock price has fallen dramatically. So because I want you to remember this, because it kind of sounds very juicy to write a question on. This is scenario one, this is scenario two. Just going to throw in some color in this. Make sure you remember these scenarios. All right, I'll share these notes with you so you can download them from the chat box towards the end. Okay, section number 7 is section number, kaun sa section tha ye? 6 is concluded. Let's go to question number 7. Sorry, section number 7. Almost to the end, we're done. Section 7 is on financial modeling for number of shares. Imagine you're a sell-side analyst. You need to forecast future EPS. You need to forecast what will be the EPS 1 year from now, 2 years from now, 3 years from now. If you want to do that, then you need to forecast number of shares, correct? How will you forecast number of shares? Here's a general framework you will use. You will say basic shares opening value plus the number of RSUs vested or ESOPs exercised during the year, because by that I will share the PDF. Can we focus on the class please for a bit? मैं सब दूंगा आपको. Let's study now. Basic shares plus number of RSUs vested or ESOP exercised during the year, plus you have issued any new shares, for whatever reason you wanted to raise some money in the market, minus if you bought back any shares, buyback. This will give you closing shares. Is that a general template? That what were the shares in the opening plus maybe whatever new shares employee actually bought this year, plus if I issued new shares for some acquisition, maybe I needed more funding, preferential issue, whatever, minus shares bought back. Now the trick here is, how will I find out in the future कि boss इस साल employee कितने shares exercise करेंगे? For example, I want to know, like let's assume companies issued 10,000 ESOPs. I want to know that next year how many, this is not a what if now, I'm building a financial model. How many of those 10,000 will be exercised now? So what you do is, curriculum recommends, you look at number of shares exercised as a ratio to number of total ESOPs ratio in the past. Very simple. For example, last year there were total 100 shares, 20 of them were exercised. So you take that last year's data and you say, okay, on an average it looks like whatever number of unexercised ESOPs we have, 20% of those get exercised every year. So you use that 20% ratio, you multiply and you assume these are the ESOPs exercised or RSUs vested. And once you do that, then everything else is easy. Then you have your number of shares ready. So on the exam, if they decide to write a case study here, they'll give you this ratio. Okay. They will say that on an average, 20% of the outstanding ESOPs are exercised every year, and they will give you a number of ESOPs which are there. You take 20% of that, and that's how you build your financial model. All right. If you've understood this, I'm glad. Now you want to know, fine, I want to forecast number of shares which are anti-dilutive, so that I can calculate diluted shares. How will I forecast that? So again, you look for a ratio of number of shares or ESOPs which were anti-dilutive as a ratio to total number of ESOPs in the past. So on an average, 10% ESOPs go anti-dilutive. So then you have some sort of a reference for that. That's your another forecasting technique. Okay, again, just look for, I hope they're making you're using past reference to figure out what could be the numbers in the future, right? I hope these ratios are making sense to you. These ratios are not given in the curriculum, by the way. I'm making them up. They've just explained in paragraphs. But this is the summary. Simple past ratio. Correct. That means 90% are dilutive. So I need to add those 90%. That's it. Then one more thing. Okay. One more financial modeling implication. When I calculate FCFF or FCFE, what do? I do net income plus non-cash charges plus other items, and then plus others. I'm just writing others. I don't want to get into minor. That gives me FCFE. Now, is employee comp non-cash? Yes, the ESOPs or number of shares issued. Curriculum says, even though they are non-cash, treat them like cash expense for FCFE purposes. Because the curriculum says some of the tech companies, a big chunk of their employee expense, they pay to them in the form of ESOPs, and that is happening in the last 10 years or so. So if you completely ignore this, right? If you completely ignore, Shakil, I'm trying to answer that. If you completely ignore, you're missing out a big part of value transfer from company to employee, which, in a true sense is an expense. It might not be a cash expense, but it is an expense. So when you're comparing valuation of two entities, one prefers to pay employees in cash, one prefers to pay employees in ESOPs, you might end up generating a very large cash flow for a company which is paying in ESOPs. But from an economic perspective, the valuation of the two entities should be same. It's just the transfer of value mechanism is different. So even though theoretically it is incorrect to consider a non-cash expense as a cash expense, but practical valuation perspective, it makes sense to consider them like a cash expense. Okay, I hope that answers the query. Then just these terms, the two terms, and this section is over. There is a concept called a closed pension plan, and there is a concept called a frozen plan. Okay, what is a closed plan? A closed plan means no new employees will be added to the plan. A frozen plan means no new employees will be added to the plan, plus the no accruals for existing employee. That means the plan is end, finish. So imagine you got onto a defined benefit plan. First 10 years, your pension was kind of accumulating, right? Based on the pension calculation formula. But in the 10th year, company decided to freeze the plan. That means they will not add any new employee to this plan. But for you also, that plan is over now. Whatever pension you've earned by working for 10 years, that you will receive. But 11th year when you work, that benefit you will not receive in a defined benefit plan. Then they might shift you to defined contribution plan. That is referred to as a frozen plan, just a term that you know, so that you can deal with questions on the exam. Okay, I need to wrap up now. I'm almost at the end. Now I'm going to go on section number 8, the final section for today, and we are done, which is on accounting and disclosure. Okay, you might find that for a crash course, this is a little nuanced, but I'm doing it intentionally because based on the feedback that I've heard from level 2 candidates who recently took the exam. The feedback that I got was, they said, question can come from anywhere. It's difficult to say that this is important, this is not important, right? Question can come from any of the section. Based on that feedback, that's why I'm building a little more nuanced crash course so that we have good coverage. So last section and then we're done. Okay. Now, defined contribution plan accounting is very simple. What is accounting? All the contribution made is shown as a operating expense, and it is a outflow in, help me out, outflow in CFO. Finish, end of the story, nothing there. Okay. Defined benefit plan accounting is tough. By the way, defined contribution plan, you know that, right? I'm not repeating stuff that's obvious. There is no asset, there is no liability that's recognized. You just show employee comp expense, end of the story. Defined benefit plan under both US GAAP and IFRS. Okay, both US GAAP and IFRS. On balance sheet, we show net funded status. You know that? You know that, right? This is from level 1. Net funded status means asset minus liability. If the assets are more, we just show the net assets. If the liabilities are more, we just show the net liability. So I'm not spending more time on it. Now, what if a firm has two plans? Can they have two separate pension plans? Yes. They have a DB plan. Okay. And then they have a OPEB plan. What is OPEB? Other post-employment benefit. What does this include? Something like hey, I'll take care of your medical expense, that kind of stuff, right? Other post-employment benefits. So now, generally for this plan, companies don't create assets. Okay, so let us say the funded status here is I have plus 90. Plus 90 means it's a surplus or deficit? Surplus. That means I have more assets. And funded status here is minus 20. That means it's a deficit. The question is, can I net off the two when I report on the balance sheet? And the answer is, and I'm glad some of you know it, can I net off the two? No. So if I have two separate pension plans, one of them has an asset, one of them has a liability, I cannot net off the two. I have to report them separately. Therefore, curriculum goes on to say that there have been instances of the companies where they've simultaneously reported an asset and simultaneously reported a liability. If I were writing a question, here is how I will write, because I know that everyone knows this, right? So I will write that an analyst is studying a company and he sees that on the asset side there is a pension asset, but he also sees that on the liability side there is a pension liability. He discusses that with his boss. Boss says that's not possible. And then in my MCQ, is it possible? Yes, no, something else. And the answer is yes, it is possible. Even for one plan, you cannot show asset and liability separately, but there are possibilities of having two different plans, one having a surplus, one having a deficit. So a company can end up having both a pension asset and a pension liability on the balance sheet. Okay, so that's one disclosure. What is the next disclosure? Super important table that I'm preparing for you. Your pension expense is made of following parts: current service cost, past service cost. These two items combined together are called service cost. So on the exam, if they just use the word service cost, you need to know it includes current as well as past. I'm not getting into details of what they mean. I'm assuming you know that. Current service cost, past service cost. Then interest expense, interest income, actuarial changes, difference between actual return and, help me out, expected return. These two items combined are called what? They are under US GAAP, the term that we use for them is called remeasurement. Sarvesh, I am impressed. Remeasurement. Okay. Now, under IFRS, current service cost is shown in income statement. Past service cost, income statement. So IFRS uses the language that service cost is to be shown in income statement, but when they mean service cost, they mean current service cost as well as past service cost. Interest expense, income statement. Then interest income, income statement. Remeasurement, both the items, they go into OCI, both of them, OCI. Okay. US GAAP, current service cost, past service cost, OCI. Interest expense, income statement. Interest income, income statement. These items, income statement or OCI, you have an option. If they go to OCI, then you might want to amortize them. Okay, how amortize? Amortize using, tell me what? Corridor method. You made me so happy when you answered that on the chat box. That's impressive. Corridor method. What is corridor method? You take 10% of the higher of assets, plan assets or plan liabilities, and then your amount accumulated in OCI minus 10% of higher item. This excess amount is what you need to amortize over remaining service life. For example, let us say that amount accumulated in OCI is 100. Okay, plan assets are 900, liabilities are 800. Which one is higher? 900. So I take 900 into 10%. How much? 90. So how much do I need to amortize? I need to amortize excess value of this 100 minus 90, which is equal to 10. Over how many years? Let us say over 5 years. Okay. Where is that 5 years coming from? Remaining service life of the employee. Like these employees I think will work for 5 more years. So then this year amortization expense will be how much? 10 divided by 5, 2. This is how corridor method works. This method is used only and only in US GAAP. Okay. Then what do we do in IFRS? Do we amortize? No. This remains there. But how about this OCI? Is this amortized? Yes. Is this amortized using corridor method? No. Then how? Amortize directly over remaining service life. Okay, now some of you might have feeling that this is too much to remember, correct? But the trick is I'll be sharing this PDF. You've attended the session. If required, you can watch this video again. We'll be putting this on the LMS and you can use this presentation, revise multiple times, you will memorize it. Are we done? No, because we still have to do some more nuances on this. Okay, what nuances? It gets a little technical. Let me open my teaching notes here. Under IFRS, these items, okay, are shown as a operating expense. That means they are before EBIT. Okay. Then under IFRS, these two numbers are netted. We don't show, for example, interest income is 60, interest expense is 80. So I will show only expense of 20 on the income statement. They are shown below EBIT. Net interest income or net interest expense. Remember, under IFRS, discount rate is same as expected return on plan assets. Discount rate is same as expected return on plan assets. In US GAAP, it can be different. Then under US GAAP, this is operating expense. And you know why I'm emphasizing on this? If you go and solve curriculum end of the chapter questions, you would realize they've actually asked on questions on these technicalities. Just the end of the chapter questions. And last time when I was solving them, I actually got stuck in one of the question. Then we had to go and read this section carefully. This is operating expense. Then under US GAAP, these two items are not netted. They are shown separately. They are shown below EBIT. All right. And now the only thing left to remember is the cash flow treatment of this. And the only cash flow that's recognized out of this entire accounting process is cash contribution by employer to pension plan. Correct? We are accounting for the employer, not for the pension plan. So cash contribution made by the employer to pension plan, and under both, this is an outflow from CFO. And finally, we are done.